Hello everyone, my name is Anjani Kumar Khetan. I'm based out of Bangalore and I'm really happy to start a new series of video dealing with another important accounting topic, which is prior period errors. So in the first video in the series, we will talk about the conceptual clarity of this term, what these prior period errors are all about, and we will continue our deliberation in subsequent video as well to deep dive into the topic. So just to set the context around this prior period errors, as we all know that when a company prepares its financial statements, the financial reporting also is not immune from possible errors. It is possible that when an entity is preparing its financial statements, those statements can also have some kind of errors. And therefore, sometimes when financial statements are published by an entity, they may contain errors, and those errors either can arise on account of some mistake by accident, or it could be a conscious design. It may be that an entity intended to achieve certain objective from a financial reporting perspective, and therefore they might have consciously done something wrong which was supposed to be there. And therefore, these errors which may creep into the financial statements can either be unintentional or it could be intentional as well. Now, Ind AS 8, and for that matter, IAS 8 from an IFRS perspective, it deals with the treatment of such errors which have crept into the financial statements. So if some errors have happened in the past in these already issued financial statements but could not be discovered at the time when these financial statements were issued, how to deal with such scenario. That means if financial statements are issued at this point in time and later subsequently you figure out that this financial statement which was issued in the past had some error, now you need to correct it. How to go about it? This particular problem statement is addressed by Ind AS 8 from an Ind AS perspective and IAS 8 from the IFRS perspective. As I mentioned, that subsequently when errors are discovered, it becomes necessary for the entity to correct those errors in the financial statements with a view to ensure that the financial statements present relevant and reliable information in the period when such errors are discovered. How it all is required to be done, that is something which we will see as we deep dive into this particular topic. So let us first see what prior period errors are in the context of how the standard considers them, how the standard defines them, what comes within the category of prior period errors, and then I will give you some illustrative case studies to explain the concept of prior period error. So what they are? If you look at paragraph 5, both of IAS 8 from an IFRS perspective or Ind AS 8, both the standard, paragraph 5 says that prior period error is either an omission or a misstatement in the previously reported financial statement. So the example which I gave from a timeline perspective, if you have issued a financial statement at this point in time, if there is an omission or a misstatement in this particular issued financial statement, and that you subsequently identify, this falls within the first leg of the definition of prior period error. So it says prior period error is either an omission or misstatement in the previously reported financial statement. Why those omission or misstatement happened? Because of this. Such omission or misstatement is arising on account of the inability of the entity to use reliable information. So either the entity has not used the reliable information which was available, or when they wanted to achieve a particular objective, they are misusing the reliable information available and try to achieve a particular outcome. And therefore, how the standard defines is that these prior period error, they are the omission or misstatement in the previously reported financial statements which arise on account of either the inability of the entity to use the reliable information or misuse of the reliable information which was available when the financial statements were authorized for issue, when they were issued. And such reliable information could potentially have been reasonably be expected to have been used in the preparation of the financial statement, but those reliable information either were ignored or they were missed to be used, or they were kind of at the entity, let's say, forgot not to use those, or there was a problem in the sense that somehow they missed using that information while preparing their financial statement in the past. So that's how the prior period error is defined in the standard. Paragraph 5 also gives you examples of what can potentially qualify as a prior period error. So examples of prior period error include effects on the financial statement on account of, let us say, the arithmetical mistakes which has happened in the financial statement, or possibly the oversight. When you are preparing the financial statements, some mistake has happened. You did a proper due diligence. Some oversight has happened, and because of which you missed something, okay? Or you done some mistake which should not have happened. Likewise, mistakes in applying accounting policies will also fall within the category of prior period error. Or prior period error could be a fraud intentionally done by the entity, or misinterpretation of the facts. The entity wrongly interpreted certain facts, and therefore that wrong interpretation led to errors in the financial statement which you have issued. So if you try to further look at these, I've given you the examples here of each of these categories of the mistakes which is possibly happen. So for example, if you look at when it comes to arithmetical mistakes, it could be mistakes like error in casting, error in calculations, error in, let us say, carry forward of the numbers from one year to another year. This can be all basically either because of the mistakes arithmetically or oversight. Or mistakes could be in applying the accounting policies. For example, you have wrongly offset certain assets and liabilities. As a general principle, assets and liabilities are not allowed to be offset unless they meet certain conditions in the criteria. But assuming that you have inappropriately offset certain assets and liabilities, that could be an example of mistakes in applying the accounting policies, because you are not otherwise allowed to do the offsetting in those circumstances. Likewise, fraud. So for example, undetected major theft in the past. If you've had a theft in the past, because of which, let's say, your cash have been embezzled or inventory has been stolen, and that goes undetected, and you have already issued the financial statement without taking into effect those frauds or the unintended undetected major theft which has happened. Same way, misrepresentation of facts. So for example, the concept of adjusting event versus non-adjusting event. So let us say there was a misinterpretation, and because of which an adjusting event was considered as a non-adjusting event, and because of which, because you did not consider the event as an adjusting event, your issued financial statement did not incorporate the effect of such adjusting event. Those are the examples of prior period errors which the standard gives in paragraph 5. So additionally, paragraph 41 gives you additional guidance to say that yes, we have seen what prior period error meaning is. What are the examples of this? And paragraph 41 further clarifies that these prior period errors could be in any of these 4 categories. in terms of recognition, in terms of the measurement, presentation, or disclosure. So whether you should have recognized something or not, if that is in error, that is also in prior period error. Likewise, measurement, the quantum, at what amount you should have recorded something. If the amount quantification is wrong, that is a case of error on account of measurement of the particular transaction involved. Likewise, presentation and disclosure. Irrespective of the nature, if any of these categories is the prior period falls into, then that would meet the definition of paragraph 5. So paragraph 5 and paragraph 41 need to be read together for the purpose of determining the prior period error. So let us see some case studies and then we will conclude this particular video. So in first case study, let us look at this what they are, whether in this particular case, is there a prior period error or not. So let us say, consider a scenario in respect of CD Corp where in FY 23-24, in this period, 23-24, after the entity's last year's financial statement of 22-23, they have been approved and issued. The entity in this point in time, they identified that there was a latent defect in the composition of a new product which is manufactured by the entity, and so the defect was there, a latent defect. A latent means something which could not have been discovered by reasonable and customary inspection. That means the error was there in this particular period itself, but that error was latent, that could not have been potentially discovered by applying reasonableness or customary inspection. But fact of the matter is that in this 22-23, that error was there, which got detected only in subsequent year 23-24. Now, as a result of this particular defect in the manufacturing, the entity incurred, let's say, 1 lakh rupees in the unanticipated cost for fulfilling its warranty obligations. In respect of which sales? The sales which have been made before March 23, before this period. So you are in this period. Now you are incurring 1 lakh of additional warranty expenses related to the sales which have been made in the prior year, in 22-23. Apart from the 1 lakh rupee of the warranty additional expenses, an additional rupees 20,000 was incurred to rectify the latent defect in the products which are sold during 23-24. Now, not only 1 lakh you spent for the additional provision for warranty of the last year, even in this year, let us say if the defect was identified at this point in time, now during this period of time, you have sold goods. That is, this point says. Further, an additional rupees 20,000 was incurred to rectify the latent defect in products which were sold in 23-24, which is the current year, before those defect was really identified. And out of this 20,000, so 20K you have spent here. Out of this 20K, 5K related to items of opening inventory as of the previous year. That means, though you have sold goods here, part of the goods were from the opening stock and part were produced in the current period. So out of the 20K which you have spent to rectify the latent defect, 5K related to the opening inventory and 15K for the current period. The defect, let's see here, the defective inventory was reported at cost of rupees 15,000 in 22-23. At this point in time, this inventory on which you have spent 5,000 of the additional rectification cost, this inventory was reported at cost in 22-23 financial statements when the selling price less cost to complete and sell was 18,000. So the lower of these two numbers, you would have gone on the basis of lower of these two numbers, and 15,000 was your value of the inventory by applying the principles in IAS 2 or Ind AS 2 dealing with inventories, cost or NRV, whichever is lower. So this inventory valuation, opening inventory valuation, was on the basis of this lower of this 15,000 and 18,000. The accounting estimate made in this is the most critical point in this particular case study. It says, yes, error has happened in this period, which was discovered in 23-24. But the error was latent by any reasonable expectations, by reasonable and customary inspection. You could not have identified that mistake. And that is what the last point says. The accounting estimates made in the preparation of 22-23 financial statement were appropriately made. Therefore, there was no error per se, because the defect was something which was not visible, it was latent. No reasonable care would have identified those mistakes. So the question is, given these fact pattern, is it a prior period error in accordance with the requirements, what the definition, what we saw in the previous slide on what is prior period error? No, it is not, because all said and done, all of this information, the moot point here is this, that the defect in this case, though it existed at this time, it was neither known nor it was reasonably possible to detect those defects as at 31st of March 2023 when these financials were prepared or before they were actually issued. So because of the fact that the defect was neither known nor it was reasonably possible to detect those, because the defect was latent in nature, and therefore in this case there is no prior period error which needs to be corrected subsequently. But let us see the second case study to contrast this fact pattern. Let us see what is the other fact pattern. Now consider a scenario herein, while preparing the financial statement for year ended March 2023, 22-23, you are preparing the financial statements and you observe the following. These are the issues which you figured out in the last year's Ind AS financial statement. That is, when you have issued 21-22 financial statements, those statements had these issues. But you are figuring out those issues only subsequently in 22-23 when you are preparing the financial statements for the second year. What were the issues? Let's see here. The entity in these 21-22 financial statement, the entity presented certain material liabilities as non-current in its financial statement for 21-22. While preparing the annual financial statements for the next year, 22-23, the management discovers that these liabilities, which were shown last year as non-current, should have been classified as current. So the problem is, a liability in this year which was current was actually shown as non-current. And this wrong classification is discovered subsequently in the next year. The management now intends to restate the comparative numbers in this year for the prior period presented. That means when they are preparing the presentation for the financial statement for 22-23, they intend to restate the comparative number. Now the moot question what we are trying to figure out, whether this wrong classification, wherein a material liability which should have been classified as current was classified as non-current. Is it a prior period error? Yes, it is. Why so? It's a very simple thing which we have seen in the earlier slide where I said paragraph 41 says that the prior period error could be in any of these four categories. It could be for recognition, measurement, presentation, and disclosure. So in this case, yes, the reclassification of liabilities from non-current to current is considered as the correction of error within the meaning of Ind AS 8 or IAS 8. Because if you read paragraph 41, which we have explained here, then it definitely read with paragraph 5 definition of prior period errors. Yes, it meets the definition of prior period error. It is a prior period error, and therefore in the financial statements for 22-23, the comparative amount for this 21-22 would be restated to reflect the correct classification. That is what the requirement would be, that yes, you have done the error here, you are detecting the year in subsequent period, okay, then correct it. corrected in this period, and the comparative now you show correctly when you are presenting the financial statement for 22-23. So this is what I wanted to cover for this particular video, wherein I just introduced you to the subject of what prior period errors are. And in the next video, we will look at whether all prior period errors need to be corrected. Now we have seen here the examples of prior period errors. Now next logical question is, having understood the meaning of prior period errors, whether any and every prior period error need to be corrected the way we have explained here by way of retrospectively doing the restatement, or there are any leeways. That is something which we will see in the next discussion. Next week, we will have one more video in this series where I will deal with this particular topic, whether all prior period errors need correction or there is any relaxations under the standard. This is what I wanted to cover for this particular video. This is the YouTube link, and this one is my LinkedIn profile. Please connect with me, subscribe to the channel, share this content to anyone whom you deem appropriate, who is in need of these kind of a video, and help the channel in whichever way you can. So I'll take your leave now for this particular video. Bye for now, and we will connect with you in the subsequent video. Thank you.